What's up, investors? It's the Russian dude, and Wall Street is issuing warning that this Federal Reserve pivot we are seeing right now, that basically they are switching from rates hikes to rates cuts. This is what was one of the biggest triggers for corrections or even recessions in the past. The question is, will this happen this time again? To begin with, it is extremely important to talk about the most recent statements that the chairman of the Federal Reserve, Jerome Powell, was giving. Basically, he said that the economy right now is showing some promising signs. This year it was expected that the GDP growth, the economy will slow down and the inflation might rise a little bit in some industries, and this is exactly what we are seeing right now. These are not ideal signs, but this is not the worst case scenario. Another important thing for the Federal Reserve to start cutting the rates is also the labor market. It must slow down a little bit, but it cannot slow down significantly, because otherwise there will be another problem. For this reason, right now the Federal Reserve is also keeps a close track on this particular sector of the economy, and in case the situation goes out of control, they are ready to take so-called swift actions. And ultimately, Jerome Powell did mention that the Federal Reserve will not be waiting until inflation hits their target of 2%. They will start cutting rates earlier than this. This is pretty much the pivot we were talking about in my last week, I think, Friday video, that yes, once again, personally I did not expect that they will start cutting rates this early, because they might reaccelerate the inflation and undo all the process. But well, this is what Jerome Powell said. But the numbers do not lie. Right here, for example, you can see the graph which shows all kinds of inflation in relationship to the target inflation of 2%. And I'm talking about the CPI, PCE, core CPI and core PCE. Every single one of them slowly is going towards 2%. Recently it is barely budging, but the process of decimal points, like hundreds of tenths of procents, I mean, yes, there is some kind of progress. Because of this, the futures market already bets on the high probability that already this year we're gonna see at least 2 rate cuts, which will equal total of 0.5%. With the maximum expectations by the market that there might be up to 3 rate cuts this year, totaling of 0.75%. And according to some financial organizations, such as for example Moody's, the very first rate cut might be as early as already in July of this year, but majority traders and market participants expect the very first rate cut to happen in September. And this is where we might potentially see a problem, because historically, all the way since 60s, there were 9 total pivots of the Federal Reserve, whenever they were changing their policies from rate hikes and just keeping the rates at the same level, when they started switching to rate cuts. As you can see from this graph, every single time there was a Federal Reserve pivot, there was at least a small correction all the way down to full-blown recession. The smallest decline was approximately 5% in the 80s, with the biggest one being right after the great financial crisis in 2009, with the decline being more than 56%. And on average, during these 9 Fed pivots, the average decline is approximately 27.25%, which is already in the territory of a recession. So this is exactly what we're happening right now. This is the 10th pivot of the Feds we are seeing right now. So, I mean, it is history. History always tends to repeat itself. So we might see this once again happening, well, as early as already next month. And just one of the possible theoretical explanations why the market declines so much when supposedly exactly the opposite should happen, because I mean, Federal Reserve finally eases the economic tightening, they reduce the interest rates, and supposedly the economy should thrive. Well, the stock market is doing completely the opposite. Once again, the one potential explanation of why is this happening is the following. First of all, whenever there are signs of that the economy is overheating, The first thing that the Federal Reserve is doing is increasing the interest rates to kind of slow down the economy, not to let inflation to be out of control. And as soon as they see that the inflation starts budging, as soon as they see that the inflation even stops increasing at all whatsoever, this is when they start holding the interest rates at the same levels. This is one of the first crucial moments when exactly you start doing this and at which levels you hold the interest rates. Because if they are not high enough, the inflation might reaccelerate in the future. But if you hold them long enough and on high levels enough, well, this might stall the economy. And the second crucial moment is when exactly you start doing the pivot. Obviously, they want to see once again the inflation to go down and the labor market to be a little bit more unstable, to see more unemployment too, in the very basic understanding. And the second crucial moment is when you start reducing the rates, not to let the economy suffer completely, to kinda balance the inflation, the interest rates, so the economy is like once again in constant balance. And so the reason why we are seeing these big declines right after the Federal Reserve pivot is exactly the following, because the interest rates are low, the traders and market participants who are very impatient, they expect immediate results, they see, well, the interest rates are low, so my company should perform extraordinarily good. The revenue must increase in double digits, the earnings, the net income, everything should be bright in the near future. And when inevitably this does not happen because these consequences, they have a lag effect. Once again, it does not mean that immediately there will be a result in the economy as soon as the Federal Reserve decreases the interest rates. It takes months for these actions to have consequences within the economy. Once again, this is what is so-called lag effect. And so this is exactly what scares market participants so much, because they see that the economy is very loose, the interest rates are low, the labor market is very active, and yet the companies are underperforming. So they start selling, there's a fear, panic, FOMO settles in, and well, people start selling, it's chain reaction, the stocks decline, the stocks fall. The best case scenario, it is only a correction of 10% or so, it might even reach a recession of 20% more or even up to 50% plus. And once again, the data shows that all the way since 60s there were 9 Fed pivots, every single one of them ended up in the stock market declining. Let's see if this is gonna happen this time once again. Because the most dangerous words on the stock market are, this time it's different. Well, as you can see, it's never different. History exists so people learn it, so people study, so people don't make the very same mistakes. But well, the humanity has very short memory. And there you have it. Thanks so much for watching. Please like this video, subscribe to my channel. This was interesting, informative for both. See you tomorrow.